In 2002, the second largest telecommunications company in America simply vanished, and the man who built it claimed he had no idea how. Bernie Ebbers made a calculation. It was 1983 and he was a former basketball coach in Mississippi running a small long-distance telephone company called LDDS. He looked at the fragmented telecom landscape and saw an asymmetry, hundreds of regional carriers, each operating in isolation. He decided to consolidate them. That decision to acquire first, ask questions later would reshape American telecommunications. It would also, within 2 decades, produce the largest accounting fraud in U.S. history at that moment. By 1998, LDDS, rebranded as WorldCom, had swallowed 60 companies. Ebbers understood something crucial. Wall Street didn't reward slow, steady growth. It rewarded growth itself. The metric mattered more than the method. He raised $37 billion in stock and debt to fuel acquisition after acquisition. Investors watched the stock climb from pennies to over $60 per share on paper. Ebbers had created an empire worth $180 billion. But he'd built something else too, an obligation to never stop growing. Here's what investors didn't know yet. The acquisitions were bleeding cash. WorldCom was burning through operating revenue just to integrate systems, lay off redundant staff, and service debt. The growth everyone celebrated was being financed by debt, not earnings. Ebbers and his finance team faced a choice in 2000. They could slow acquisitions and admit the model was unsustainable, or they could manipulate the books. Ebbers chose the latter. He didn't sit in a room and decree, "Let us commit fraud." Instead, he created an environment where fraud became inevitable. He set unrealistic earnings targets, double-digit growth quarter after quarter. He made clear that missing targets was unacceptable. His CFO, Scott Sullivan, and controller David Myers inherited the pressure. They began reclassifying normal operating costs as capital expenditures. The effect was immediate and dramatic. Expenses vanished from the income statement. A capital expenditure sits on the balance sheet as an asset. It's depreciated over years, not expensed immediately. This meant WorldCom could report massive profits while actually losing money. Between 2000 and 2002, they reclassified $38 billion in operating costs. The stock remained elevated, dividends flowed to shareholders, executives cashed out stock options worth hundreds of millions. The house of cards held temporarily. In early 2002, Ebbers faced another crisis. The telecommunications industry was collapsing. Overbuilding had flooded the market with fiber optic capacity. Prices fell 80%, demand evaporated. WorldCom's stock plummeted from $64 to $20. Ebbers had borrowed against his stock to buy more stock, a classic trap. He was losing his entire fortune in real time. Desperation sharpened his focus on one objective: keep the stock price up long enough to save himself. Fraud accelerated. Auditors from Arthur Andersen, the same firm that had enabled Enron's collapse months earlier, were already compromised by WorldCom's lucrative auditing contract. But one person inside the company began to notice irregularities. Cynthia Cooper was an internal auditor. In early 2002, she started pulling threads. She found entries that didn't match supporting documentation. Massive journal entries that bypassed normal approval channels. And the deeper she looked, the worse it became. Cooper knew the cost of speaking up. Enron's whistleblower, Sharon Watkins, had been marginalized and threatened. Cooper worked quietly, gathering evidence. She reviewed the reclassified expenses. She traced the $38 billion in fraudulent entries back to their source. By May 2002, she had enough. She drafted a memo to the audit committee detailing the scheme. Ebbers still didn't know she was coming. On June 25, 2002, the audit committee received Cooper's findings. 3 days later, WorldCom announced it was restating earnings. The $38 billion in fraudulent reclassifications would be reversed. The stock collapsed 62% in a single trading session. Investors who trusted the company lost $180 billion in market value. Employees saw retirement accounts evaporate. Pension funds were wiped out. On July 21, 2002, WorldCom filed for Chapter 11 bankruptcy, the largest in U.S. history at that moment. Ebbers was forced out immediately. He claimed publicly that he had no knowledge of the fraud. He'd been focused on strategy, he said. He trusted his finance team. The investigation would later show something different. He'd pressured them relentlessly, created impossible targets, and ignored warning signs. Whether he explicitly ordered the fraud or simply created conditions where it became necessary remains debated. But the outcome was identical. In 2005, Ebbers was convicted of conspiracy, securities fraud, and filing false documents. He was sentenced to 25 years in prison. Scott Sullivan, who'd executed the fraud, cooperated with prosecutors and received a lighter sentence. David Myers also pleaded guilty. 5 WorldCom executives went to prison. The company's auditors at Arthur Andersen faced additional scrutiny that accelerated their own collapse. But the cost was already paid. 17,000 employees lost their jobs. Pension funds lost $5 billion. Small investors, people who'd saved for retirement, lost their life savings. The fraud cost Americans an estimated $11 billion in direct losses plus immeasurable damage to market confidence. Ebbers made a calculation in 1983 to consolidate telecom. He made another calculation in 2000 to manipulate the books. Both were decisions made under pressure, with incomplete information, and both had consequences that echoed for decades. The WorldCom collapse taught markets an expensive lesson. Growth at any cost isn't strategy, it's desperation. Accounting standards tightened. The Sarbanes-Oxley Act passed in 2002, forcing stronger internal controls and CEO certification of financial statements. Cynthia Cooper became a symbol of internal dissent done right. She won a whistleblower award and wrote a book. Ebbers, meanwhile, died in prison in 2020 at age 63. His empire reduced to a cautionary tale taught in business schools worldwide. Subscribe for the next corporate collapse, where ambition met reality and one person's choice changed everything.